Good morning, everybody. This is Patrick MontesDeOca, CEO of the Equity Management Academy and trading leader in Ticker-Taker. What I would like to do today is to show you and share with you the latest report that we published in the Associated Press through Seeking Alpha for the basically period of the balance of this month, and also as we move into the next 360-day cycle that started back in September 28, 2020, all the way through September 28, 2021. What I would like to do also is take a look at the 9-year cycle as it relates to that 360-day cycle and see what the gold market is telling us for this period. The first thing I would like to do here is share with you the report that we just published entitled, "The Highway to Inflation is Open." Summary. We are looking at a pretty dark winter in terms of any kind of economic activity. One of the reasons we focus on gold is that gold is going to be a major beneficiary of the situation. Governments are printing endless amounts of debt in terms of US dollars, thereby reducing the value of each dollar. This is a generational crisis, but it also is a generational opportunity. We're looking at a pretty dark winter in terms of any kind of economic activity. Curfews are starting in California. New York schools are closed. It feels again like the first time in March when we were first hit by the pandemic. The markets reacted tremendously, dropping more than 1,000 points. The fundamentals appear to mirror the sentiment that we had in March, with the difference that this is the second wave. As we move into the winter, this only can get more complicated. How do we take advantage of the situation? One of the reasons we focus on gold is that gold is going to be a major beneficiary of this situation. Gold collapsed in March related to the tremendous sell-off in equities, which also affected precious metals. It was liquidated to raise cash to retain positions. Usually, when there is a large sell-off in equities, investors often liquidate precious metals to meet margin requirement for stocks. In March, we saw the first impact of the pandemic economically, and gold fell and then rose more than $600 an ounce. At the top, the market got too rich too fast. This was a historic high. It was a historic rally to new highs. The paradigm then changed, with gold becoming a currency. In 1971, the paradigm shifted when the dollar was taken off the gold standard. In 2020, it shifted again. The US dollar is a paper fiat currency with no real backing to protect its intrinsic and purchasing power. Gold has value and is now a currency of sorts. Governments are printing endless amounts of debt in terms of US dollar, thereby reducing the value of each dollar. The US dollar has fallen 98% compared to gold since 1971 and is continuing to fall. This is a general crisis, but it also is a general opportunity. The economic system is going to have to change. In January, we have the Davos Economic Summit with all of its elite. They were responsible for the 1971 decision to eliminate the gold standard. The gold then became the petrodollar, more tied to the price of oil than to gold. And right now we're facing mountains of debt. We have doubled our debt since 2008. Banks have $2 quadrillion in risks in derivatives. They have not and did not reduce their risk of leveraging, but have continued to increase their leveraging since the 1970s. The volatility in the market is so great now that no trader can handle it. You need to use artificial intelligence and algorithms to help take your emotions out of trading. With help, you can embrace this historic opportunity to make tremendous profits. It is difficult to sort out real news from propaganda. One way to cut through the noise is to listen to what the market is telling us. The stock market continues to rise to the benefit of the wealthy, such as those who can borrow money at almost zero interest rates and then buy stocks and make a profit with almost no risk. Big corporations can buy their own stock and literally make free money. The government is not only supplying free money to play with, but it is also guaranteeing the other side of the market by saying that they will be a buyer of last resort. No matter what happens, the government will buy you out. The U.S. can do that because the government can print as much money as they want to print. And they can use that money any way they want to. They are leveraging the asset base of the U.S., which means it is coming out of all of our pockets. Someone will have to repay all of the debt. And it will be the taxpayers and all Americans for generations to come. What they don't say is that the more stimulus they provide, the greater the risk of inflation and even hyperinflation. Check out shadowstats.com for real inflation rate, which is about 2%. And you're beginning to see gold, the realization that all of the stimulus money is going to come back to haunt the dollar in terms of its purchasing power and inflation. And it will no longer be the world's only reserve currency. Globally, debt only increases, and we are moving into an even more debt-laden economic system. Interest rates have to be kept near or at zero for a long time, or the entire system will collapse under the weight of the debt payments. Even as a slight increase in interest rates will lead to a tsunami of debt defaults. All of this is leading into an economic climate that is going to be highly inflationary. Gold will benefit from such a climate. So we strongly recommend that at least 1/3 of your assets should be in gold and silver. In the short term, the Fed and the Treasury appear to be preparing for another bazooka of stimulus to hit the market. And the gold market appears to be anticipating more stimulus to hit the market. Let's take a look at the 360-day cycle here that you see on the left of the chart. And the 9-year cycle is on the right of the chart. Now, what we have done is we have extrapolated a very specific structure that we use to identify the extreme levels of the supply and demand within this particular time frame. Once the algorithm identifies the average price for that particular structure, then it can extrapolate for us the extreme levels above that mean in terms of where, from a mathematical point of view and a probability point of view, it would be at an extreme. The average price is 50% standard deviation, and what this algorithm does is it identifies for you within that specific structure a 50-90 to 50-90% probability of the relative implied volatility to the mean. In this case, the market trading at 1875.70 it pretty much, by closing, if we take a look at the 360-day structure, the market is in a bearish trend momentum, and it has activated the targets of 1810, which is the 360-day average price, starting September 28 of 2020 all the way to September 28, 2021. And the artificial intelligence behind the algorithm basically is identifying that because the price is trading below the average price, let me just correct myself here as we take a look at the market price trading above the 360-day average price of 1810 has activated obviously a bullish trend momentum when it crossed and closed above this level on June the 30th of 2020. It activated a buy signal, and when the buy signal is activated, it automatically activates as well the targets above, and within that structure, it activated the 2164 level as the 360-day cycle for the next 360 days. This is the sell one level, which is a 50-90% standard deviation relative to the implied volatility. The sell two level is 2442. This is a 50-95% of the relative implied volatility to the mean. What this means basically is that when the price reaches this level, if the market activates the trigger point, there is a 90% probability that the price could revert back to the mean. The core principle of what we do is trading the reversion to the mean principle. And I have written a book called Mean Reversion Trading that you can, if you would like to, just reach out, subscribe, and we will be very glad to send that book to you. It's free. And it really breaks down the components that I use essentially to trade in a live account, as well as to coach and teach my subscribers, my traders, in a private live trading room, basically how I am applying this information. And what I'm doing right now is I'm identifying as a trader, just like you, where the market is in relation to the 360-day cycle, as well as the 9-year cycle. And for the time being, what we have identified here is that the market trading above the 360-day average price of 1810 has activated the sell one target of 2164 for the remainder of the cycle period. And the sell to level is 2442, clearly identified by the sell to level. The market closing below 1810 would negate this signal to a neutral position. If we take a look at the right of the chart, what we're looking at basically is the 9-year cycle that identifies for us the average price for the next 9-year cycle is 1675. The buy one level is 1262. To $638. The sell one level of the extreme above that 9-year average price is $22.99, and the sell to target is $27.12. On the 9-year cycle as well, the fact that the market is trading above the average price has the sell one level target of $22.99 activated. And the protective level will be, if it closes below 1675, it would negate this 9-year cycle bullish trend momentum to neutral. Recap. It appears that the 360-day cycle is in a bullish trigger that essentially has the 2164 as your target in place, and your protective level will be a close below 1810. If the market closes below 1810, it activates obviously the extreme levels below that average price, and it identifies as the buy one level the 1532 level to 1178 that are potential levels that the market, if activates the trigger points, will come into place. Underneath the 360-day cycle that we're looking at, the average price of 1810, if it closes below 1810, the first target connects the 9-year cycle of 1675 into place. And then what we want to see is basically what the market does if it does get to that level and identifies the trend at that point. We have taken a look at the two sides of the market here that we're going to use basically to trade the gold market into these periods of time. And once again, what we have identified so far is that the 360-day cycle and the 9-year cycle are in a bullish trend momentum, with the initial stop of the 360-day average price of 1810 and the 9-year cycle of 1675. Hold your positions long with the initial targets of 2164, which is the 360-day sell one level, and 2299, which is the sell one level of the 9-year cycle. I will continue to produce this podcasts on a weekly basis as we publish all the reports in the Associated Press and Seeking Alpha for the benefit of my subscribers and self-directed individuals. Thank you again for the opportunity to do this. And until next time, my friends, good trading. We'll talk to you soon.
Hello, everybody. This is Patrick MontesDeOca, CEO of the Equity Management Academy, with a weekly podcast for December 11, 2020. We're going to take a look at the last report that we published in the Associated Press, basically titled Gold. Don't get left behind the short squeeze. This article was published in Seeking Alpha on December 11, 2020 at 9:46 a.m. Eastern Time. Summary. After the 2089 high of gold in the summer, gold has moved down about 50% from that high. Our goal is to increase our holdings in gold long term. We like what we are seeing in gold. We continue to buy corrections. More recently, grain and soybean prices are exploding and are a major signal that food inflation already is here. Gold. On Wednesday, 7 a.m. Pacific Standard Time, the gold was trading at 1851.70, up about 12.30. The market was trading above the variable changing price momentum indicator, daily, weekly, and monthly average prices. Although this does not identify a day trading signal, it does identify the trend momentum of the market. With the market above the average daily, weekly, and monthly, prices are in an uptrend. And the targets that we're looking at is 1870 as the sell one level on the daily. The weekly target is 1874. The daily sell two level is 1898. The weekly sell two levels is 1906. So the first target is 1870 to 1874. The prices almost match harmonically, which is a very, very powerful sign. As we take a look at Nugget, when this report was published, Nugget was sharply higher as all the other derivatives, and we have confirmation that the low that we saw yesterday in this area of 1824 in the gold market could be the second higher low confirming that the bottom was made at 1767. On November 30th. It did not reach the 1822, which was the daily level. When the market came yesterday, came down toward that buy 2 level, we reached the weekly levels of support in this area where buyers are likely to come into the market. After the 2089 higher gold in the summer, gold moved down about 50% from that high. Now we have established a low. The 50% was a high from the low that was made in March at 1451 to 2089, and we're looking at a 1771 as the 50% Fibonacci. Now we have established a low which appears to be the completion of this retracement. And it looks like gold may be setting up to once again challenge those highs. The 1768 level, which is the recent low, is potentially going to be the annual low. Our goal is to increase our holdings in gold long term. We like what we are seeing in gold, and we continue to buy corrections. Fundamentals. A high was reached on November 9 when the efficacy of the vaccine was announced. And the market, however, is not trading based on vaccine news. Gold is looking at the damage that was done by the pandemic. It devastated the world's economy. Unemployment is still around 10 million unemployed. We have yet to see the effect of the second lockdown and the economic impact. It's going to have on some of the small businesses that survived the first wave. They may not survive this second lockdown. That means there will be more economic damage and more pressure on the Federal Reserve to print more money and pump more stimulus into the economy. More pressure is being put on the system. Confidence confidence is being tested in the current system. Many people have been a victim of the system collapsing. The system was manipulated to create an elite group who took advantage of the system by keeping interest rates low, printing more and more money, and creating a debt economic system. And the system has led to the biggest wealth gap in U.S. history. Very few are in a position to borrow money, but those who are can borrow at almost zero interest and invest it, such as in stocks, and reap major profits. A lot of these disparities in the system are being questioned and have become hugely unstable. Whenever the economic system historically collapses, gold retained its value. The US dollar has already lost 99% of its value against and since 1971, when the US went off the gold standard. Very few notice the silent killer that is inflation. More recently, grains and soybean prices are exploding and are a major signal that inflation is already here. Soybeans are up 50% recently. The inflation now has not reached Main Street, has not reached Main Street yet. It's mostly in stocks. We're looking at the price of soybeans, which is the leading economic indicator of the cost of food, hit a high of $12 here, November 24th. And this represents the cost of food. We're going to see this increase reflected in retail prices if we are not already are seeing it. The inflation factor went into the stock market, as you can see, reaching a high of 37.14, 37.15 on December 9th, 2020. Interest rates have been cut to almost zero, while at the same time the Fed has quadrupled their balance sheet. Since 2008, a staggering rate in the past year. The graph for debt looks like a hockey stick, straight up, which is why interest rates had to come down to near zero. Or how could they pay for that debt? With debt so high, interest rates will have to remain low for a long time. If the economy begins to pick up and inflation starts, what are they going to do? If they raise rates, the debt will quickly become unmanageable. Amidst all the news and chatter, we use the VCPMI to focus on what the market is telling us in order to trade without emotion. We are also trading the Bitcoin market by using the Grayscale Investment Trust fund that basically is the trust for Bitcoin, registered with the exchange, and it follows the direction of Bitcoin in the cash market. And so the difference is that we do not believe that Bitcoin is a currency. To compare it to gold, which has been around for thousands of years, is a mistake. Bitcoin has only been around for 10 years approximately, and we trade it, but we don't see it replacing gold either in our portfolio or as a currency. Bitcoin is not a tier 1 asset. You cannot borrow against it. Once something is all over the media, it usually means it's headed for disaster. And it appears we are likely to move in a multi-month correction if this 2412 target, which is the high that we saw, and we took out some money at that level, and we bought gold. We strongly recommend not taking money out of the gold market and buying Bitcoin. This would be a big mistake. What you want to do is trade Bitcoin either through the futures markets or the Grayscale Investment Trust, GBTC, short term, and take that money and build a foundation of gold and silver. Central banks may soon issue virtual currencies which will regulate Bitcoin in some way. At least they would heavily regulate other virtual currencies that are not backed by the government. Regulation for Bitcoin and virtual currencies is coming. So it is a big risk to put it all in Bitcoin. Be careful. Be prudent of the inherent risks, many of which have not been defined. We're looking to trade GBTC on the long side. It appears that we came down to a level of support, and it is a great tradable instrument because it has tremendous volatility. That means it's great for short-term trading. If you can manage the volatility with a trading system, such as the VCPMI, is an intelligent way to trade the market. We went long. We took a buy signal on GBTC at 1945. And we've already have taken some profits out of the market here on this rally that we saw the market up to 2150. Review. Continue to buy corrections in the gold market. Ideally into levels of that previous low of 1767 to 1789 as we complete this week.